Welcome to Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors, and I'm thrilled to have back on the show after a couple of weeks' rest, Evanlucas. He's our resident behavioural economist, and we expand on the original interview with him, which I definitely recommend you tuning into, and focus on things that investors are going to be looking at in 2025. I speak to him about the power of sentiment outside of the power of metrics and data, and what actually drives human behaviour to make certain decisions or invest in certain markets. So he unpacks for us some of those biases and the ways sentiment can be powerful in moving markets. I have a chat to him about what we can learn from the behaviour of people in helping us to identify markets that have potential or momentum. And of course, we unpack the situation with interest rates. We've had the inflation print since his last appearance, and I pick his brain about if and when we should expect an interest rate cut. He has a prediction for what will happen. He also has a little bit of an X factor into why that might be incorrect, and it could be a little bit different to what the market is pricing in. Heaps to unpack, and gold, as always, from Evan, who's one of my favourite people to have on the show. Here's Evan. Evanlucas, thanks for joining me back on Geared for Growth.
Mike, it's great to be back again. I mean, I loved our last discussion, and I'm sure this one will be just as ridiculous and fun and entertaining as the last one, because you and I were riffing bad. So for those of you watching and listening, bear with us.
No, it's good fun, and I think today's episode will probably zero in on the meat and potatoes of what's on investors' minds at the moment. But I wanted to sort of start in your area of expertise very specifically in and around buyer and seller behavior. Now, obviously, you're a behavioral economist, and people do behave in weird ways. And if you take that from a macro perspective, it does influence the way markets move. So I wanted to get your insights into us human beings. Are we lizard-brained monkey people, or are we perfectly rational investors?
Well, okay, let's take that last bit first. So the first time that was sort of proposed, that question, as are we lizard people or are we rational? You had economists in the 1850s, sort of 1820s, 1850s, proposing this idea of, they used the full-on like physical anthropology analogy of going human economicus, which is Homo economicus idea is that we are 100% completely rational, that the human being and the Homo rationale idea is that we do everything to advance ourselves, to grow, and to basically do the maximum potential opportunity for us, which would basically, if you take that concept, what they were arguing is that Homo economicus was basically constantly putting the best return opportunities they could. So had perfect market information, had perfect, or clearly when you hear this, it's absolute rubbish. Mm-hmm. I mean, it doesn't exist. Having a complete rational human would mean you've got a robot. Now, maybe AI can fix that for us, Mike, in terms of what we go further forward, but it doesn't exist, because the other argument for that is that would mean that the younger you are, the more leverage gearing in a bad sense that you'd probably want to take out. Right? Mm-hmm. So housing does have a leverage component to it anyway, because we're going to have to take out some form of mortgage or some form of investment lending to get it. That's fine. That's a different thing. What the concept they were saying is that basically, if you're at about the age of 30, you should be doing gearing of 2 to 1, and right, more likely to 6 to 1. Doesn't happen. So the concept then also flips the other side, is that, are we irrational? Now, that isn't the case either, because there's no such thing in investment worlds. What we do is we're trading off. We're making trade-offs. We're making that constantly, which would mean my argument would be it's not rational v irrational behavior. It's rational versus reasonable behavior. Mm-hmm. And because you can't have perfect information. You just can't. It's not possible. Even again, with AI coming forward, you can't have complete 100% rational, constant, perfect information, constant understanding about the market, because it just doesn't exist. So you are making trade-offs. You've also got defense mechanisms that will come into it as well that sort of go, hang on, if I put myself at a fairly high leverage rate, what does that mean for my family? What does that mean for my kids' education? What does that mean for my, my ability to live and have the autonomy that I want to have, they're the trade-offs. They're the rational questions that human beings are asking. And the other thing that goes against human behavior, all of that is choice, right? All of those things that I just said are choice. And technically humans don't want to have those levels of choice, because we actually end up getting into this position where we freeze because we can't make the decisions we need to. So in answer to that, and the long-winded answer to it, is that we are making trade-offs right now constantly. And we are looking at all the different scenarios that play out in our individual worlds. And those of you listening out there would understand that you are making those thought processes. What is the best for my opportunities? Do I do X, Y, Z? Does X trump Z? Blah, blah, blah. That's all part of what's going on right now.
And these trade-offs, they're not made in a vacuum where your trade-offs mirror my trade-offs, which mirror someone that we could randomly point to on the street. They're impacted by our own biases and fears and aspirations as well, right?
Yeah, correct. And so, that comes back down to, you'd pick a million of them. Is it familiarity bias, confirmation bias, attention bias, all of those kinds of things that sort of play out there constantly over and over again. I mean, familiarity bias in the property investment world is a fascinating one. We were speaking before off air about, what's going on in Victoria, and I'll come back to that in a minute. But why I highlight that is that the normal investor in property will invest in what they find familiar, even if that means it's not the right thing to do. I mean, if you look, the majority of investors will invest in the area they know. So if you live in Sydney, you're more likely than not to invest in Sydney overall. If you live in Melbourne, same answer, Adelaide, so on and so forth. And that's where, thinking outside of that bias needs to become part of your thinking. Loss aversion comes with it as well, is that, all of this money that I've got to put up, I've got to stump up, I've then got to pay, debt requirements and debt repayments. That money, in my view, is dead money. Now, it's not, in terms of the fact that if the asset's appreciating above the debt, it's fine. But again, all of those biases come through, and gets back to that rationale that they're playing into it, is that, is this in my interest? Am I getting my financial autonomy that I want? Is this actually growing my wealth in a way that's, beneficial to all? That is all those questions that at the moment is playing very, very hard in particularly the investment property market, and why we've seen, markets like Victoria, for example, moving away from areas they would normally invest in.
Now, we will come back to Victoria, but let's go to the other end of the spectrum. 2024's golden-haired boy, Perth. 90% growth, and it didn't have a bad year in 2023. I'm wondering what we can learn from it. I mean, there are people smarter than myself that said back, I think in October 2023, that the fundamentals weren't there from an investment point of view, yet it continued to carry on. And I wonder how much humans are the reason for that to continue on. Is that a confirmation bias? Is it FOMO? What can we learn about that market that can help inform our decisions as investors going forward?
So let's actually go outside property and look at another market that basically answers that question with regards to, this is attention bias, attribution bias, as we refer to it. And it's the combination of all of that confirming yourself. If they're doing it, it must be right. So let's look at cryptocurrency, completely outside of our world, but everyone's making money out of crypto. It must be right. It's going to the moon. The attention that it creates, the confirmation that your view is right, that it creates, allows you to buy into exuberance and allows you to buy into exuberant markets. When Trump was voted in, you saw cryptocurrency, so let's take Bitcoin as the example, go to 109,000 US a coin. And it's come right back since, again, because it confirmed this idea that we've got a president that's right into crypto and he's going to do X, Y, Z, and it's going to modernize it. So let's look at Perth. Perth is going to boom again. The Chinese story is coming through. It's, the only state in the country that's got a cash surplus. Their overall government structure is incredible. They've got exposure to gas and mining exports. They are the largest state landmass. Take your pick. They all confirm your bias, though. Right? They all confirm that answer that, it's Perth and there's no other option. Well, then let's also stay in WA and have a look at what happened in Port Hedland. Now, this is an extreme example, but again, everybody was talking about Port Hedland being this next new hub, and it has been, but the fluctuations and cycles that comes with BHP and Rio investing in that space and, you know, pulsing how much iron ore they either produce or don't produce has put Port Hedland at the whim of that movement. So, you know, everybody knows about the stories during the tens about, you know, Port Hedland was offering you basically a fall down shack for 7 figures, and they were renting it out to your Rios and your BHPs of this world for, you know, 4 figures. In terms of what you were getting a rent per week, and then it crashed. Now, Perth is not the same thing, completely different, I understand, in terms of the fundamentals, but it gives you that same concept in the fact that Perth has run for a reason. It was lagging the rest of the eastern states. There were other reasons it was lagging, but then we got the exuberance. And the last 3 years, I would argue, has been exuberance.
Interesting. Let's go to Victoria, which is probably the opposite. It's a market that traditionally has always been sort of third place median price after Sydney and Canberra. And Canberra we put off to the side because
let's just leave that to one side, shall we?
It's a weird paddock full of public servants on $1 squillion a year. But Melbourne is now middle of the pack. And I spoke to Kate Bakos yesterday, who is a buyer's agent in Melbourne, and she said that the inquiry is crazy at the moment, and she pins it down to the fact that there is a super high expectation of the next RBA move being a cut.
Yep.
But it sort of begs the question, I mean, let's say there is a 25 basis point cut and maybe we get another couple. It's not necessarily big enough to move the market in a meaningful way, but somehow sentiment is supercharging that in my view. Would you agree?
Yeah. So the data agrees with you too. So
right.
If you look at the data with regards to consumer confidence in the Melbourne market, for the first time in 2.5 years, it jumped back into optimism. So it went from pretty so 100 is the equilibrium between optimism and pessimism. Yep. It's been sitting at about 80 to 83 for most of the surveys that come out of the Melbourne Institute Westpac numbers. And then about November last year, it jumped up and also jumped back above 100. It's only just above it, but whatever way you look at it, the rate of change from pessimism to optimism is incredible. The same data also shows you that technically Melbourne, and to some extent Sydney as well, has corrected. So if you look at the rate of change, the price of change, it's moved through neutral pullback. It's now hit correction territory. So there's 2 parts to that in terms of why that's happening. There's a belief, and that's what the term straight out is. It's always airy-fairy when you use the term belief, but there is a belief that we are in a buyer's market. Like there is a feeling that we have got a Victorian market that is technically the second largest city in the country. One day will become the largest country in the country. If you look at net migration into Victoria, it's back positive rather than being negative in the post-COVID world. That's demand, right? So therefore, I must be right. It must have a rally. I need to get in now. Listings have been up, and they are above trend, but not at a level that would get you really, really exuberant. So this is what I think would be interesting in this concept is I actually agree that Melbourne will have a good year because it's coming from a low base and demand is coming through almost inverted commas artificially because there's this idea that Melbourne's missed out. We've seen investors get pushed out. We now think that the land tax has caused a fundamental structural shift and I can get in. It's not going to be that simple. And there will be opportunities. I can't deny that, but it's not going to do a Perth. I want to point that out quite clearly. It's not going to do a Perth catch up. It might sort of outpace Sydney for a little bit because it does have gaps. But again, you go to the flip side. The other investor psychology on this is that if you're a Melbourne investor or a Melbourne property owner and you see that Melbourne technically has gone back, 3.5% collectively, there are, LGA, so local government areas that have gone back as much as 9%. You're not going to sell because you don't want to crystallize that perceived loss on paper. So Melbourne will be fascinating. I'm not surprised that the great Kate is getting the amount of inquiries she is because she is incredible at what she does. And I think she will continue to do that, and buyers agents as will. But I am a little bit hesitant to sort of call Melbourne as the panacea of 2025, because there are other issues that will come at play.
Real shame, because that would have been a great clickbait title for this show. But
it will have some good returns, but there are still structural issues in there. If you're an investor, you're still staring down the barrel of land tax issues in Victoria, and I live in Victoria. You are probably also staring down the possibility that there will be more. I think that also needs to be very clear. Even though we've now got a new treasurer down in Victoria, she's facing the same structural problems that was with the previous treasurer. And the thinking,
debt's still there, right?
Yeah, and the thinking hasn't really changed if you listen to what's coming out of her office. So there's a caveat overall with regards to property in Victoria, is that there is still government intervention that I don't think's over.
So that kind of begs the question, what's more powerful, the metrics or the sentiment? Can sentiment outdo metrics, or do we require some sort of almost like a standard candle to grab hold of to be able to sort of anchor our bias?
Well, there's another bias for you, anchoring, in terms of, another line to sort of use it. So in answer to that question, it varies, but right now it's sentiment. So Let's take the fact that we've just gone through a rate hiking cycle that we haven't seen in, basically 3 or 4 decades in terms of the speed and rate and change. We've gone from 0.1% to 4.35%. That's 13 rate rises in the space of 14, 15 month period. And it's been holding there now for going on 10 months. In fact, it's more than that. It's a year. I forget, the last one we moved was actually November 2023. We held all the way through 2024 and we're now into 2025. What is fascinating is that the metrics would normally suggest, and history would show you, that lever would normally slow the housing market down. Mm-hmm. And we haven't done that. No. It's actually still gone. Perth, great example. But we forget Brisbane's not far behind it. Adelaide was at its peak and only just showing signs of slowing down. Sydney's only just slowed down at the end of September 2024. So sentiment is still there. And I think I said this last time when I was on your show, it was the one thing that human beings can't buy is time. We can't buy it. The great Warren Buffett uses that line as one of his things. The only thing he can't buy is time. He can't buy time and press stop, but he can gain time. And that's what he talks about with what he does with his wealth, is gaining time. The majority of us are getting to that. That's one of the sort of the whole concepts that we have in investing. It's why you're all investing in property, is that you're trying to gain time, having your wealth behind you to allow you to do the things you want to do, when you want, how you want. But we also have sentiment that comes with it. Time also means that you are getting older every single day, and therefore you can't stop what that brings with you from a lifestyle perspective. And I've said this to you before, Mike, and I've said it at PIPA events or any sort of property I talk about, is that in the end we go from being single to a couple to possibly being a family, to a family with kids, to a family with more kids. That requires just bigger and bigger expansion of the nest that we live in. So time can't be stopped, and therefore the sentiment also overrides the short-term economic or structural changes that we're experiencing. COVID, 13 rate rises, 2012 through 19, where we basically had the ride of our lives with property, because rates were basically sitting at that time record all-time lows, and just things were cruising through. We didn't realize how good we had it. I mean, there's an argument that maybe the RBA left it for too long. They probably should have stoked growth a bit sooner than it did. But again, these are basically eras that you can just point to in hindsight. But into the future, it's exactly the same. You can't stop time, and therefore the sentiment will always keep pushing demand into the beautiful world that is property.
So the focus of the show was, well, how do we use what's in your brain to help predict emerging markets? But just to stay on Victoria for a second, because it's a really interesting case study in, say, political or legislative intervention and the ability to see how people reacted to that. So the land tax issue has been a huge one, and we did see a lot of people selling. We saw a lot of investors voting with their feet and investing in other states as distinct from Victoria. In our own data, it was long-term average at 16% of all of our investors would be active in Victoria. As at the time of the land tax change, it was 9, and it dropped basically overnight to 4.5.
Yeah.
We
So
don't
it's
have
halved. I mean, what a stat!
Yeah.
And that what a confirmation of cause and effect.
Yeah, exactly. And I think, it sort of begs the question, if they were trying to alleviate some of the rental affordability concerns, they've definitely exacerbated it. But I think it was just more about, okay, we're going bankrupt here, we've got to do something. And investors, nobody really sort of like gets a little violin about them. They're just like wealthy land barons.
The other thing about state tax is that, what else can they do? State tax is a really funny one because realistically they've got payroll tax and then property. It's the only thing they're allowed to control. And you're right. What's the easiest option? Property. It's always property. Despite the fact that, your data will show over and over, and most investment property data will show you over and over that it's mums and dads that they're hitting, that they're actually hitting, people with wealth that's in the scheme of overall things is pretty medium to low. Yes, there are some really big hitters out there, and that's different, but they're the ones they'll pin up rather than actually the mass and the impact that the mass has. It's also why it works, because they know it captures a lot, but they just won't talk about the mass. They'll talk about the pin-ups, the bad ones, in their eyes.
Interestingly, at the last federal election where negative gearing was on the chopping block, I remember Chris Bowen being asked about, well, why don't you just limit it to people that have, say, less than 6 properties or 4 properties? And he said, we're looking at that. And I think the end reason is why they didn't do that is it's not a meaningful amount. Like if you have 6 or more properties, I think you're around about 0.5 of 1%. Like you're not in the top 10%, the top 1%. It's narrower than that.
Yeah, and so therefore the tax collection and the pain and suffering politically that comes from that is too low. The argument has always been that if you're going to go after negative gearing, you need to tier it, right? So, you go first house can have 100% negative gearing, second house 75, so on and so forth. You bring it into the same tiering structure idea as personal income tax, and build it that way that you can then, only write off a percentage of the total that you have in your 4th, 5th, getting to basically the argument is most people have the bulk of them is about 3 in terms of where it starts to really sort of move out. And then once you go above 3, it gets there. So, you would say that once you get to the 4th, you're probably staring down the barrel of going, you can't write that off. And so, I mean, I've also said this many times before, if you're basing your wealth investment decisions on a tax policy, you're probably doing it wrong. So this is the other thing to think about, is that us as property investors, us that work in the property market, need to accept sooner or later that this change is coming. It's going to happen because it's probably going to need to. It's more about working with government in a positive way. And this gets back to my world and what I talk to my clients about. Because you asked before about, what is the next thing with regards to Victoria and where do you look to it? So, and the future of it, taxation changes are going to have to happen. We have got a structural change basically a structural tax deficit that we can't deal with if we don't change. We just have to change. That is coming. We as investors need to accept that and be on the front foot and actually advocating for what is a fair, inverted commas, fair system. Flip side, let's look at other things, which is the future idea of where government can be involved to help basically, the investment that needs to happen to have that market that we can get excited about. So let's use what should be realistically the pin-up, not Perth. It should be Townsville, because Townsville is the market overall that's probably done the best in 2024. Why has it done the best? Because the infrastructure spending that has been done there hasn't just been build a train line, or it hasn't just been build a road. It has been build the things that we as human beings need the most: education, health, job security, those 3 things, right? So what they've done is they've built hubs. They've built industrial hubs that actually drive the economy of Townsville. They have got, new high-end, health and education hubs. And so no wonder people want to move there. No wonder people want to live and do that. Now, despite the fact that Townsville's quite a decent distance away from Brisbane, and, you're talking about a 2.5, 3 hour, flight in terms of where it's going, depending on where you're coming from. And the train can be as much as 9 hours. But overall, it's a place you want to be. It's because it's moving, it's growing, and it's exciting for that reason. So let's get back to Victoria. if Victoria wants to change itself in terms of that direction, the West Corridor and looking at the Princes Highway down to Geelong, it's there right for the picking. They're starting to try and do the right things. And what I will point out to clients about my futuristic ideas is the economics of it is teetering to the right side. It's getting there, right? If they start developing the point that basically the hubs of the future are going to be in Werribee, are going to be in Point Cook, are going to be in Avalon, are going to be joining Geelong to the Melbourne corridor, which is already starting to happen, but actually not just building a high-speed rail and going, go your hardest, everybody else. Government part of that is that if you're going to take revenue of investors and property, is we're also going to build the hospitals that people want to live in. We're also going to build the hubs that we want you to do, which is high end. I mean, again, health is a great example. Biotech in Singapore is a great example of that. Build the biotech spaces and they will come. Same concept. If you want to be a service provider, have, AI services. We don't need to compete with developing AI, but we need to be a service provider of AI. Why not? Why can't we be that? And a Melbourne is just the example I'm giving you, but it could be, you look at what's going on in Parramatta and the drive to try and push big organisations out of Sydney CBD and out towards Parramatta. So the ABC is a great example of that. They are the decisions that can actually create the next move. And it can even be more simple than that. A new complex that is going to be a combination of, shopping and light industrial areas with a hub of some form of transport around it. So again, Sydney's a great example. You look at that sort of Midwest area in Sydney, they're trying to do that. I mean, Homebush was the sort of example of that concept. They are what I, and if you guys are listening to this and you want to chat to me, please reach out. This is what I talk to clients about. This is what, and how you identify that future economic opportunity is that where is that, infrastructure being spent? Where is that dollar going? And therefore the spread that it will give in the surrounding areas.
Yeah.
Sorry for the plug.
No, that's fine. And I'm sure there are a lot of people that would relish the opportunity to have any time with you. I'm wondering, though, with Victoria and that specific land tax change, is that an example of a knee-jerk reaction that is probably disproportionate to the actual stimulus? And do we tend to behave that way with a negative stimulus, but be a little bit sort of more on the pessimistic side when there's positive news? Is that a human thing?
The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
It is a human thing. So, I know you've heard me say this before, and those of you that haven't, I love using Isaac Newton as the great example here, because it's like Isaac Newton's physics are actually Isaac Newton's behavioural economics. And his third one's the greatest one that we always forget, which is that for every action, there's an equal but opposite reaction. For every tax paid, for every tax action, there's an equal but opposite taxpayer reaction without fail. And it's something you're taught in economics, not even at university. You're taught about this at school. And it fascinates me that governments sort of seem to forget this over and over and over again. Let me take you an example. They do know it works. Health. So I've been talking about that a bit. You look at the tobacco excise. That's not a tax policy. That's a health policy. They are deliberately driving up the price of tobacco products to stop you from doing it because you can't afford it. It's the same. They're now doing it pretty much with alcohol, and why the beer industry example is whinging over and over for pretty reasonable reasons, but the government's response will be, no. Realistically, they know that it's a health policy, because if they can get lower amounts of alcoholic-related health issues, it takes pressure off the health industry and the health cost. They then deliberately sort of, I feel, sometimes forget that same reaction that they want to get for your behaviour for tobacco and consuming alcohol is what also happens in everything that we do with regards to tax. It's why negative gearing is so attractive to people, or why Australia is one of, if not the largest provider of trust funds on the planet, because we are trying to find ways to get around the fact that we pay an enormous amount of personal income tax. It's extraordinary how much personal income tax we pay in this country, and it's part of the reason why the average household isn't getting ahead. It needs to change. Again, we need to be having a fair decision and discussion about that into the future, but that's for another talk for another day. So that is all part of that answer, because the reaction is completely normal human behavior. We are going to go and turn around and go, well, hang on a minute. Why am I now forking out so much money? All of it's not just the land tax, it's just the culmination of so many different legislations that Victoria is putting in place. So the taxation is one of them. You then have all of the safety and administration costs that have now been put into it as well. The fact that you've got to review the gas meter, the fire every year at a certain price. It's also, again, I don't like, but the NDIS, and the fact that you've got providers that are certified only, and they are basically just knowing they're the only providers and driving price up. And so the price of, and then you've got other administration costs on top of it. Then you've got your agents' fees that are still growing. You just put your hands up and go, I'm out. Yeah. And that's so it was probably the final pebble to push the stone. We've pulled that final pebble out. The stone's now falling down the hill, because there are so many additional things that have just, people are human beings and they go, this is not worth my time, effort, and return. Is the amount of opportunity costs, personal costs that aren't necessarily equated in, dollars and cents, has it now overtipped the value that I get from actually having that property? And your data shows you it has. Half of people are now selling out.
But
winded answer, sorry, bud.
No, that's what you're here for. This is all gold. Now, but I read, Evan, in paper that Melbourne go up because mean reversion. Discuss.
Look, yes, it will. I mean, we discussed that somewhat at the start. Because, again, that is the psychology of it, right? That is the psychology. Melbourne's corrected. It's got to go back to the mean. I've got to get in now. I'm going to create or get that bump. Now, again, the mean reversion is about 3.5-4%. That's not necessarily a return in property world that you want, right? So it doesn't matter which market or which investment you apply this to. It's the same concept. If you're investing for a short-term reason, forgetting that this is a long-term opportunity, then you are going to find yourself, trying to time the market rather than being in the market. A property investment is a 10-year investment minimum. And you and I talk about this day in and day out over and over, is that this is a long-term opportunity. And if you're jumping in for a short-term reason, does the short-term reason also stack up over the long term? If it doesn't, that needs to be your answer. Or are you trying to time something and get in and out, and therefore what's your out? Is it getting back to the mean and then stumping out and making that quick flip? Okay, maybe that is your answer. That's fine. But you've got to be really, really strong and very, very organized and structured to do that. Because particularly in property, I mean, it's a very liquid moving asset class. It takes months, in and out to sort of do it. It's not like, the world that I've originally come from, which is, equities and bonds and stuff like that, where liquidity is instant. So if you're doing short term because you're mean reverting, okay, that's fine. But you need to have all of your ducks in order today for in and out. And that is, you and I would tell you over and over in property, is not a property investment structure or a strategy that we would certainly see working on a regular basis. Is that a fair answer?
Yeah, absolutely. It does sort of seem like investors are sort of thinking, okay, well, we know that it's a long-term thing, but why not get that market that's doing its stuff at the beginning? I think maybe for two reasons. I think if we're investing in a market that does 20% in 12 months, there's an opportunity to revalue, pull equity and go again. So we're broadening our exposure to appreciating assets. But outside of that, it's like, okay, well, if I vaguely believe Brisbane, Sydney, Melbourne will all do 7% year on year for 20 years, it makes sense to get the market that's actually going to give me more of that in the short term. What are your views on that?
It'd be the same answer. You're right. I mean, again, it's like anything, which is if you've done your research and it shows that you're going to get 8% collectively over 10 years because of a short-term bump you might get in the first bit where it's, it's a 10% increased growth, but the average is 8% versus a 7%. We know from compound interest and the beauty and the amazingness that is compound interest that 1% difference over 10 years can be as much as a 20% gap difference to the upside. So, yeah, I mean, there is the maths behind that. There is the history behind that. And that is fundamentally something that textbooks and theories will show works. So there's no way to look around that. Again, what I'm sort of suggesting here is what's going on, again, using the Melbourne example, a confirmation bias that you believe it's going to happen, or is there actually, theoretical evidence and real world evidence behind your thinking? If it is, that's more the answer than the feeling.
Feelings are fun though.
They are. And again, they drive us on all things all day. And there is no ways to get around it. And you and I do it all the time. You guys out there listening and watching do it all the time. It's normal. It is rational. Back to what I said at the start. It's a completely reasonable thing. But sometimes you just need to tell yourself to stop and go, am I being overly reasonable, or is there a rationale behind this as well?
Or it used to be, what would Jesus do? Maybe it's now, what would a computer do?
I hope not, because computers get it wrong too. As I said, I will say this again, Homo economicus, there is no true, full, perfect information, but we can have pretty close to it. And if the information alignment is strong enough to suggest that it's absolutely in your interest because you're going to get a 8 to 9% compound interest return over a 6 to 7%, that's a reasonable reason, a rationale to do an investment, whatever it might happen to be.
Yeah. It's interesting observing how computers are getting it wrong, and some of it seems like with AI is our fault because we're feeding them our world with our representations. It's like you trying to look at the world through my prescription glasses. I'll give you a tip. You're going to have a hard time.
It's going to make my eyes really sore. It's also, again, there's this concept at the moment with the revolution of generative AI and ChatGPT, and now you've got DeepSeek. There is something so incredibly ironic about them calling it DeepSeek, so close to deep state. But whether it's OpenAI, whether it's R1 technology, it still only learns from what you give it. So it's not going to give you perfect information. And I think we're sort of somewhat forgetting that in the last sort of 2 years, is that it doesn't give you perfect information, and it just collates all of the information, sort of brings it together and then gives you the best answer from that information, but it's not perfect. And it doesn't and can't predict futures because all it's doing is taking collation of data that's already happened and then telling you the now. All of that's part of why AI is going to be very helpful. It's going to increase productivity, but it's still not Hollywood AI. Let's call it that, right? It's still not a robot that's going to be basically able to replace you. It's not there yet. Maybe one day in the future it does, and some people will tell you it is. That's a good thing. Some people will tell you it will, and that's a bad thing. But it's by the by, because in the end, human beings are immensely clever that we just don't, to a level we don't realize. And you can still tell when something doesn't feel right. There's a little sort of spidey sense that goes on inside of you. And AI is getting better and better, and I understand that. And there are really concerning parts about it. Also, human beings are lazy, so we just want to believe it, even if we know internally there's something wrong with it. But overall, when it comes to making a decision about a house, AI won't sway us enough because it's such a large concept to get through, or a large purchase to do, that we will make sure that we do so much more input before we get a computer to tell us, yes, this is the right answer.
Yeah, absolutely. Two things that I know I'm going to get hate mail about if I don't ask you. One is sort of like the title of the show. Yeah. One is sort of the title of the show. How do we use what's in your brain to be able to identify markets that are about to outperform the national average? And of course, we do need to finish on interest rates. I'm sorry. I'm sure you're probably sick of talking about that.
No, we will never stop that question.
So help us out. How could we have identified a Perth, or how do we look at the data and the sentiment and be able to confirm our suspicions that Melbourne is going to go through the roof? What can a behavioural economist or even just economics teach us?
The answer is the same in terms of the fact that the behavioural economics. So don't forget, economics is the collation of our overall group behaviour. So there's lots of research out there that, I do and some really big players do around future-looking sentiment indicators, because future intentions normally end up being actual real-world intentions. So if you look at the sentiment that is coming in around 2025 for housing, it is to the upside. Now, I know you're going to ask me in a minute about interest rates, and it actually is independent of that, because what we are seeing is that it's the anticipation of interest rates rather than the interest rate cut itself. Old rumor, buy the rumor, sell the fact, right? Is a market comment that always happens. That's a behavioral economics answer to most of it, which is that people now also believe, and we've discussed this sort of underlying, reading between the lines sort of over this entire interview, is people are trying to beat the expectation. They're trying to therefore get in before the interest rate cuts come, and therefore the perceived wave of demand that will bring. Partly true, because again, affordability is tight and there are people that can't actually get in because they can't get the lending needed. But overall, it still applies exactly the same way, which is we have a scenario right now where there is a perception that there is going to be an upside in a market like Melbourne. And so that's partly, if you look back at Perth, you could see there was a perception that Perth at the time was trading below the eastern states. And you could hear it. People were like going, why is Perth underperformed 2021, 2022? Maybe it was because of how tight the border structure was with WA during COVID. That might be one. The fact that, you even got to hear something we hadn't heard since the 1930s about Westralia and the possibility that it could, succeed the Australian Federation and all this kind of rubbish that was going on during, the COVID craziness that was happening in the political sphere debate.
They've tried that twice. I mean, even at the beginning of Federation and then, as you say, in the 30s. And we won't let them go because, that's where all the Bernie rocks are, all the expensive stuff that we flog off.
All the expensive rocks are there. And, their economics are incredible, but all of a sudden they'd go from being a nation of 27 million to a nation of about 2. And they would be a nation more like New Zealand than a nation like Australia. So there's other sides to that point as well. And the interlocking that comes with, Western Australia to the rest of us, the country, the amount of Western Australians that live across the whole state and vice versa. I mean, I'm South Australian in terms of where I was brought up, etc. That's debate for another story. So in terms of identifying that's the sentiment is clearly there. As I said to you at this, midway through this discussion as well, is you can see the hubs that are trying to be created. Like you can see where the infrastructure is moving. You can see the opportunity that's moving. Don't underestimate, although, you can love or hate it, but what Australia is trying to do around particularly exporting renewable energy, I mean, those hubs are going to have to be created in regional towns. So particularly if we're going to do thermal energy and thermal regulation energy, that's going to have to be done out in the desert and where it is. And then, the hubs that come with that, it could be a new mining boom. It could be a new, inverted commas, not a great example, Port Hedland. But they're the things that you need to look towards in terms of where is that gas, that great investment happening. Because people talk to me about, ESG, environmental, social, and governance investment. People are like, why are we wasting our money on all this kind of stuff? Why are firms doing this? Instead, whether you like it or not, firms are investing in it. Don't fight that trend. The money is there. The money is going that way. If people want to create and make hubs in renewable energy, they're going to do it. The money will flow there. Don't fight that from an ideological point of view. You go with that concept. So that's how someone like me would look to it, is that I try and take my biases out. I try and take my confirmations out. I try and take my, ideological biases for things out, because as soon as you have those barriers, you'll miss. And that, again, it also explains with Perth. What was going on in 2020, 2021? Could you see through the fact that, Western Australia was going to open their border in 2022? Some people were arguing they couldn't. They were going to keep it shut. Mark McGowan was saying that he was going to shut it down. And, it wasn't just helping with COVID. It was keeping drugs out of Western Australia. All this kind of political noise that would have knocked a lot of people out. And the smart investors look through it and go, no, this will end. Western Australia will open up again, and away you go.
Interesting. All right. Well, we prefaced it before, and I think last time you were on the show, if we get everyone caught up with the chronology of it, it was probably 3 or 4 weeks ago, and it was pre the latest CPI data. Firstly, your read on that, and where you land now on, I think your advice at that point in time was May would be the earliest cut. The market is disagreeing with you strongly, I think, for February, around about 95% or something like that.
Yep.
But there were certain things that you had flagged or data points that you would think the RBA were waiting on that could really influence that. So starting with that print, did it surprise you?
Parts of it, yeah, absolutely. So the one that I highlighted last time that has really caught my attention was referred to as lifestyle inflation. Rent, insurance, utilities, fuel and stuff like that, etc. That fills in that lifestyle. So at the end of the September quarter, that was sitting at 5.89%.
Yep.
Then at December 31, it had fallen to 0.45, so 0.45 of 1%.
Right.
That is because there was a huge amount of government intervention into the rental market, and there was a huge amount of government intervention in utilities.
Yep.
So on paper, it looks fantastic. It certainly helps. It's correct in saying that, that is now no longer as much of a concern as it was, but it's there because of government intervention.
So we're talking about the energy rebates. We're talking about, perhaps state intervention to say, we're capping it at 12-month increases in rents at a maximum, that sort of stuff.
And also because when we talk about these things, they're a rolling 12-month average, right? So September 2023 had a really high jump up in rent rates, and that rolled out of the data. So the difference and change from the September quarter to the December quarter had also a very large piece of data scroll out of it. So fell out of the data itself.
Yep.
So all of those things are technical indicators and technical things, blah, blah, blah. It doesn't matter. So that was a big mover to the downside, and one that's really, moved trim mean to 3.2%, which is the one that the RBA cares about, versus what was probably being forecasted even by the RBA themselves at 3.4. So they're 0.2% better off than they were expecting, and it's moving faster. The other one that I talked about before was sticky inflation. So sticky inflation is those that take 4 months or more to move their prices. It's why hairdressers and dentists are always fingered for this, because they are the ones that know that their clients can see them as a discretionary item, although dentistry probably shouldn't be. And therefore they don't shift their prices until they absolutely have to. That's still sitting at 4%. It went from 4.5, but that's still at 4%. Is that enough to hold it off? Probably not. But then you look at education, still going at 5 and a bit %. If you look at housing, part of the reason housing was at 2.3% was because utilities contracted 12.8% in that quarter.
It's artificial, right?
Correct. So why I know I'm going to be wrong. So I'm going to point this out that the RBA is probably going to cut. I'm going to be wrong for forecasting May. Why I'm highlighting this, why they may surprise you is, again, someone like me is trying to forecast, and forecasts are not predictions, right? So let's put that out there. Predictions are basically crystal balling. I predict that this will change. Forecasts are, if we look at the outlook, here are the opportunities and here are the issues that could present. The forecast therefore shows that these are the spread of ideas. they're different and needs to be sometimes not, forgetting. The forecasts still show that we are not going to get back into target until probably the end of this year. So that's 2.5% inside that trim mean. The RBA still has that at 26. That hasn't changed. Right. So that needs to be pointed out there. That hasn't changed. And then we are talking about the gatekeeper, because in the end, my forecasts mean nothing. The gatekeeper is the RBA. They are the ones that make the decision. And despite the market, despite more economists than not saying a rate cut will happen on the 18th of February, which does look likely, they could still disappoint you, because if you listen to Michelle Bullock and co., she still says fundamentally that those that are most affected by inflation are the lower socioeconomic group. The group
I remember she gave a dedicated presentation on sort of like the horrors of inflation and how it's harmful to society at large.
Yep.
And I think that gave a little bit of an insight into the way that they're thinking, and perhaps some of the headwinds of commentators. Like every update, you see people like Stephen Koukoulas, calling them crazy for not, galloping to the cut. But obviously it's something that's in their mind, right?
Yep. And look, Stephen, love him, love going out to dinner with him, but I disagree with him quite fundamentally on a lot of the things that he's been saying in the last 12 to 18 months. Blaming the RBA is not the answer, because, again, as Michelle Bullock pointed out very, very clearly, these people that are most affected by inflation are unlikely to own a home. They are unlikely to be affected by interest rates. They are the ones that are affected more likely by rent. And rent is the problem. Now, there's a chicken and egg there. Higher rates get transferred through to the lower socioeconomic through higher rents. That's a different story. But overall, what she shows is that the impact that inflation has around your purchasing power is more detrimental than anything that can happen. And what we need to remember is that we are talking about the rate of change here in inflation at 3.2%. The change of price increases is only going at 3.2% year on year. Since the cost of living crisis started, it's 22% up collectively. That has not changed and will not change. It will not see a price drop. So if we are to cut rates, you're doing that because the economics is showing that things are slowing, that growth is slowing. It is, no doubt about it. We're in a per capita recession, have been for almost 2 years. It will get confirmed in about a week's time when we get the final quarter of last calendar year. That's another story again, but it filters back into this idea that if you stoke growth, you're going to put pressure on price. And we have seen in the States, we have seen in Europe, we have seen in the UK that inflation's actually ticked up again with rate cuts. We didn't go as hard as they did. The US is just at the same rate that we are now after cutting a full 1% out of their cash rate equivalent, the federal funds rate. The Bank of England, same in terms of what they have with their cash earner. You look at the deposit rate in Europe, it's below us, but they've got different problems to us. But inflation jumped up to 2.5%. They need it to be at 2%. She is weighing all of that up. So I will be wrong on February 18, but why I'm saying all those things, don't expect it to be a normal rate cut cycle either. It may be that once we have it in February, they don't cut again to July. It could be even as bad as September.
Right.
Because a quarter notch takes the pressure off the household, but probably won't stoke inflation.
Interesting.
So that will be the caveat. And that's what will be interesting to see from their forecasts and what they then talk about into the future. Because are we sustainably back to target? We'll have to wait and hear.
Yes. Well, we'll be watching with bated breath, and very much appreciate your thoughts on that and throwing it out on the table. But yeah, time will tell. With 2025, though, I know this is probably even polishing up that crystal ball to within an inch of its life. But are you expecting 50 basis points or 75 basis points across 2025? Where do you think, where does it feel like we'll land there?
So the market is still forecasting 75, right? So it's still quite, if you look at the December figures in the 30-day interbank market, it's sitting at a 75 basis point rate cut through that.
Yep.
But what it's doing, if you look at it, is that it's pricing that in for the back half of this calendar year. So if it's going to happen, it'll happen at a pretty decent clip of 50 bips sometime in the second half of the year. It could even be the last 4 months of this calendar year. I'm of the agreement of that because I think the RBA wants to see how inflation plays out. It's also got other things that are coming. The Australian dollar we haven't spoken about, but that's now at levels that haven't been seen since COVID. We are an importing nation. If the currency stays low, it does mean that imported goods will appear more expensive. Inflation.
Yes.
There's so many machinations about the hesitancy there. Again, I would get back to what we're here to talk about, which is property. Will it matter? Probably won't. And interest rates have shown that the perceived expectation are going to be more of a driver on property than actual action.
That was actually my next question. 50, 75 basis points. What does that do in reality from a metrics point of view if we remove sentiment? Because it does sort of feel obvious. And as Kate mentioned, that sentiment around interest rate cut is making people act now. And I know in speaking to a few buyers agents, there's a cohort of people that are waiting for a cut and then they'll make their decisions, rightly or wrongly. That's just, they've just
exactly what's happening,
sand.
Right? So it's exactly what is happening. So the one could be the trigger. And so getting back to my sort of thesis argument I gave you, which is that if there is one cut and it triggers a wave of movement in property and puts property price, inflation back into the inflation figure, that will possibly be their reason to pause because we're not sustainably back into inflation. Inflation's starting to reaccelerate. You forget that the in the inflation basket, the property basket, so that's rent and all that kind of stuff, it makes up near enough to a third. It will move the dial. So if the dial is moved by a third of the market because all of a sudden our world starts to stoke itself because it gets excited by rate cuts, they'll dry up pretty quickly. So this is the push-pull and why I'm not being pessimistic. There's always a glass half full to this. I'm trying to read the behavior of the board and what you're hearing from Michelle Bullock, who is the one that, she's not the only one with the new structure, but she is the face. And what she is telling you, she is the gatekeeper. It isn't as rosy as some will tell you, or it isn't as stupid as somebody like Stephen will tell you. There are so many considerations it has because in the end, the RBA has one policy lever it can pull, and that's interest rates. And I said it last time and I'll say it again. It is a sledgehammer doing fine art because it does and affects every single point in the cycle for every single sector, positively and negatively. Business sentiment, positively and negatively. Personal lending, home loan lending, home loans as itself. Everything is affected by that one lever, and she knows that. So if she stokes the property market but doesn't stoke the market she needs to stoke, which is probably business lending and business growth, because if you look at private investment and private growth, it's really, really anemic, then she's got a problem. So she has to know that when she pulls it, it's all going to work together, not against it, not a tug of war scenario. Unfortunately, historically, in the last 20 years, Australia has gone down that sort of path that, sweet, it's property time. That is where she has to deal with. And she says that, prominently when she sits down and, testifies in front of the Senate. And it's why I'd always argue the flip side. Why I don't understand why politicians pin their flag to the only policy lever they can't pull, being interest rates, when they are the ones that actually have the ability to do fine art and do fiscal policy that can actually stimulate certain parts and help things, structural reforms, productivity reforms, less red tape. These are fiscal changes that would change the behavior, that would actually allow the fine art to be done without the RBA having to use the sledgehammer and putting a hole through the actual easel itself.
Yeah, it was interesting watching both sides of politics claim either credit or minimising the value of the fiscal impetus on that inflation print. I think definitely the Liberals were overstating it.
Absolutely. And no doubt, John Howard started this. Like, let's point this out there. So John Howard, Peter Costello, they started this whole concept. The fact that Costello would sit up there and go, look at what we've done to interest rates, look at what we've done to the economy. They got lucky. right? They got lucky. They were going through the absolute upside and the top, the riding up the mountain of the China boom. Like they were, and so they got lucky. It's not, they didn't have anything to do with what happened during that period, but they then pinned their mast to it. Labor worked out that actually it's a way of getting votes, so why don't we do it as well? And then Labor got, inverted commas, unlucky with regards to when they were in power. There's no political persuasion from me on this on either side, because, again, if I listen to what's going on right now, I'm so disappointed with what has come through from Treasury. Like, they had so many good things, and listening to what Jim Chalmers was saying leading into the election and during his first year to what's happened, right? So close, yet so far away. And then you listen to before that with Josh Frydenberg, he was also claiming, look at what we've done to support the economy during COVID. Well, yeah, okay, but you also were completely indiscriminatory and had no, basically checks and balances. Now, they will argue they didn't have the time to do checks and balances. Okay, hindsight's beautiful. I get that. Just shows you that both, all colours of the spectrum in the political sphere constantly look to the political angle rather than to the actual angle they should be looking towards.
Yes, the country would be better off if they changed their view on that. But we'll probably leave that for another episode, Evan. But thank you very much for your generous time today. Lots to unpack and lots for the investors to cogitate on as we gallop into the uncertain world of 2025, but I think steeled by some of your insights into what makes these markets and the sentiments that we can look at that are going to influence the movements either way. So thank you very much for all that wisdom today.
Mike, as always, it's been a pleasure to be with you.
Cheers.